What's up, everyone? It's Scotty with MoneyVest. So, wanted to give you a little bit of an update on the markets because the 30-year bond yield auction did not go as well, and the demand definitely was a lot lower than what people were expecting. And as a result, the treasuries did jump higher, the yields did spike, which are obviously causing the markets to rethink the rally from last week. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members only private videos, intrinsic value spreadsheets, our buy and sell alerts, options alerts. Everything is going to be included with the link down below. And again, we'd love to have you on board. There is a 16% annual discount that's available until the end of this month. So first, going into the markets here, S&P 500 down about 40 basis points, getting rejected at 43.93. And the NASDAQ also just shy of 13,700. What did we talk about? In our previous market updates, we have technical levels literally pinpointed at 4,400 on the S&P, 13.7 on the NASDAQ, and guess what? Getting rejected exactly at those levels with the yields jumping quite a bit. So you can see the 10-year treasuries did spike a little bit over 1.2, 1.3% to 4.6.5%, but of course rotating back lower, and the Dow Jones also struggling a little bit, just under 34,000, down about 125 points. So jobless claims came out today. 217,000 was that number, which was again a little bit lower than the consensus, but this number continues to be at a very, very low rate, right? So we're not really seeing a lot of unemployment claims. In other words, we're not really seeing a lot of initial benefits, initial claims being filed. And as a result, this continues to suggest that the economy is super strong with the labor market being extremely tight at the moment. Now, the Treasury demand did fall off a little bit. So turnaround in stocks since the start of November looking in jeopardy on Thursday after a $24 billion sale of the 30-year Treasury bonds drew weaker than expected demand. And investors have been keeping a close eye on the Treasury market with a sudden jump in yields on longer U.S. bonds in October, viewed as a catalyst for recent weakness in equities as well. Now, look, we've talked about the three things, right? We have mentioned, and I've mentioned this time and time again, how there is three things that are actually causing the markets to sell off. Number one, the Treasury yields. Number two, the dollar index. And number three, rising oil prices, energy prices. All three things have started to rotate back lower since their July levels. They have obviously rallied, and since October, they've started to come back down. So if you go over further, you'll notice that we entered November on our back foot, and clearly the biggest headwinds for the stocks were rising Treasury rates, a stronger dollar, and rising energy prices. That was Hogan, who said in an interview with MarketWatch, and all three of those have reversed, and that's true. All three of them have started to come back down, but if they remain elevated, right, that's the big problem. Yes, they have pushed higher, they've come back down, but they're still far more elevated than they were a couple of years ago, which obviously is causing a big problem. Now, Mohammed El-Arain, he basically mentioned that we cannot have the Fed reacting to yesterday's data all the time. Their tools operate with a lag. They need to take a strategic view, and they need to stop being volatility enhancers. This unusual volatility in the bond market is not good for the economy as well. And this right here, of course, is now the biggest drawdown that we've seen for the bond market since 1976. And this is 39 straight months. 39 months of consistent selling pressure, and the U.S. bond market has now been in a drawdown for 39 months, by far the longest bond bear market in history as well. Now, it's not just treasuries. Corporate bonds have also been struggling a little bit. So as you can see that, since 2022, corporate bond yields have been rising. So they have been on a very nice, consistent, move back higher. So obviously when AAA yield goes up, what happens is prices go down because of that inverse correlation. And that has continued. And you can see the U.S. corporate bond spreads since 1920 are hitting their lowest level in over 43 years. That's a spread between U.S. BBB corporate bond yield minus the 3-month U.S. Treasury bill yield as well. And you'll notice that we are once again coming down to 0%. That is actually quite interesting if you really think about it. And in the last few times, then we have seen that in February of 07, in October of 79, in July of 73, in January of 66. All these times have obviously led to recessions and unfortunately very, very brutal bear markets as well. So going over to the market, as you can see, because of the weakness in the demand for the 30-year bond auctions, we did see a pretty significant spike, not just in the 10-year, but also in the 30-year treasuries. So we did get up to as much as 4.828%, now rotating back lower, but that's obviously causing some more fear around the strength of the overall demand for U.S. debt, because as we know that, as interest rates continue to go higher, prices come down, but at the same time, with the fiscal deficits that are running at record levels and the debt levels at over 33 trillion, that is once again creating that unfortunate or uncertain environment where whether U.S. debt is even worth buying, right? Because can the U.S. actually repay all this debt, given how high interest rates are, and can it continue to finance the debt levels that we're seeing at over $33 trillion as well? So right now what we are witnessing obviously is a resurgence in the overall yield. This week it is higher, I think a little bit over 1 to 2%. So we're up over 66 basis points with a little bit of a doji candle. And I do also want to point out that this is the overall trend for the treasuries with a higher low. And we did see a little bit of a breakdown yesterday, but today's bounce back higher. It's up over 2.4%, certainly causing a lot of instant reaction to the downside for equities. But we did also analyze one of the other reports that suggested that in the month of November, so November 6th to November 26th, the average decline for 30-year treasuries is around 30 to 40 basis points, right? So about 0.3 to 0.4% decline in the 30-year treasuries in the month of November from the 6th all the way through 26th. So that 20-day period, we do see the markets very, very weak on the treasury side, and the bond market starts to push right back up because of that inverse correlation, right? So right now we are very much in this context where we did print a lower high. The next big question is going to be whether we see a lower high over here for the treasuries or not. That's going to be sitting roughly around 4.8.5% for the 10-year, and the 30-year is also going to be on almost a similar pattern where you'll notice that we are starting to print a lower low. But again, the real question is, will this actually lead to a lower high, or if we're going to break above this resistance of 5.1, 5.2% and start to move back higher? If we do, that's obviously going to be not great news for equities because they're going to continue to find it more and more challenging to break out above this resistance of 4,400. That's exactly where we are getting rejected, and looks like the streak is now coming to an end for both the S&P and the NASDAQ as well. So a NASDAQ here, a little bit under 13,700. So that was the high for the day, as we talked about in one of our previous videos. And this right here is the overall streak. We're very much in the context of a downtrend of lower highs and lower lows. And of course, a lot of that coming off of the weakness in the bond market. Now, volatility up over 4%. And look, we talked about this. This is part of our analysis, right? We have gone over this so many times that the volatility cheat sheet is a very good indicator of when you want to be hedging your positions and when you want to be looking at dollar cost averaging or buying opportunities in the market, because it gives us a very clear directional, percentile to base your decisions off of. So again, if you want to get access to all that, link's going to be down below, and would love to have you on board. You get access to our volatility spreadsheet, you get access to our intrinsic values, our members only private videos. Everything's going to be included. But I've got a couple more updates coming out and a few other stock analysis that I will be posting for later today. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.